Now, President Muhammadu Buhari has signed into law Nigeria's revised 10.8 trillion naira 2020 budget. The budget, which was revised to accommodate current global and domestic economic realities, was passed by the National Assembly in June this year. Egie Akpata, the director of Union Capital Markets, now joins me from Lagos for this conversation and to also assess Nigeria's forex strategy. Egie, a pleasure to have you join us for this conversation on CNBC Africa. I'd like you to start first with the news of the President's final assent to the 2020 budget. Now, when you think about the 2020 budget, what concerns come to your mind, especially with regard to funding?
Yeah, I think it's better late than never. We're already more than halfway through the year, and the revised budget is just being signed. I think the big issue with the budget is that when you look at 10.8 trillion, federal government revenue is probably not going to be more than 3 or 4 trillion. So most of the budget is actually going to be borrowed money. And since most of the budget is recurrent and most of it is borrowed, clearly you're borrowing just to fund your recurrent expenditure. So that is quite worrying. You mentioned the 15% capital expenditure that will be released this month. It's still not clear how that's going to be funded, but clearly it's going to be borrowed money. So pretty much a budget that is pretty much about borrowing, and that borrowing trajectory is not likely to change anytime soon.
Yes, talking about borrowing trajectory there, that was, you just kind of took that out of my mind. Now, there have been calls from all over that Nigeria should at this point maybe look more to strategies tilting towards focusing on domestic borrowing. But with current realities, are we still able to go down that line?
Well, I think this new budget is looking for significantly more domestic borrowing. I think about 2.3 trillion. The very original budget had only about 850 billion or so. So yes, there's a huge amount of domestic borrowing in there. But again, I mean, 2.3 trillion when your deficit is definitely going to be minimum of 5-6 trillion. You have to borrow externally. So they're going to max out on domestic borrowing. And in fact, interestingly, right now, a number of FGN Euro bonds are actually trading at yields higher than their Nigerian equivalent, particularly on the short end. So it's actually much cheaper now for the government to borrow in naira. Ignoring future devaluation, is actually cheaper to borrow in naira than in foreign currency. So they're exploring that to the fullest, but the domestic borrowing will not be enough. They need a significant amount of foreign borrowing, most of which has not been put in place yet.
And so one of the major news bites that have come out since the president gave his assent to the 2020 budget also included the fact that ministries, departments and agencies will receive 15% of their capital allocation by the end of this month. What will this mean for the economy?
Well, assuming capital allocation means construction-related things, which is not necessarily correct. I think everything from tables and chairs and cars, they're all capital allocation. But it means spending that is not on recurrent or expenditure, it's not employees, it's not overheads. So that should be a boost to the economy. The government will start spending. The question is how quickly they can ramp up that capital section of their budget, because that is really what stimulates the economy. The payroll side is already recurring, and that is not incremental. So the government really needs to spend significantly in the real economy to reduce the size of the economic contraction that is currently going on.
So now to Nigeria's forex market, which the international finance organizations are very strongly tied to the economy as far as some funds that the country is looking forward to are concerned. What are your thoughts about the Central Bank of Nigeria's current intervention within the country's forex space?
Well, unfortunately, the central bank right now is the biggest supplier of foreign exchange in the market. So they more or less control the market. It has not always been that way. There were periods where the INE window was operating without much central bank intervention. As of today, they're the biggest supplier, and that is a problem because when you look at the reserves, the central bank obviously doesn't want the reserves to go below a certain number. And there's just no way the forex demands can be met right now without significant depletion of reserves. So the question is how do we go forward from here?
Now, one of the major issues cited by analysts and watchers of the forex space includes the fact that the CBN's handling of plans to clear what they call backlogs of FX demand, which is estimated to be around some $0.5 billion for offshore investors. I'd like to know your thoughts about the CBN's workings for the strategy at this time.
Well, I mean, the backlog is clearly there. Exactly how much it is unknown. The central bank has yet to tell us exactly, but there are enough estimates out there that are probably within a reasonable band of accuracy. I think the first thing is that these people clearly have to be paid. If not, it becomes very difficult for any Nigerian institution to do business outside this country. The question is, how do you pay $7 billion from your reserves without going under 30 billion? There's really only one practical solution on the short term, which is to borrow, which is why the IMF, World Bank, and all these other borrowings are in place. But they're not enough. In reality, oil is not going to be $100 anytime soon. So the oil market cannot bail the country out as it usually does. So practically, the best option the government has is to go and borrow a significant amount of foreign currency to ease these people out and stop that structure of using foreign portfolio investors to fund the reserves. Because at the end of the day, you're paying 15% in dollars for 1 year money. I don't see how that makes any sense. I mean, what they had before with foreign investors buying Omo bills at 15% plus, with an NDF protecting them on devaluation, meant these people were earning over 15% in dollars for 1 year with virtually no risk. That is not cost-effective borrowing. If the country went out to borrow money short-term, they can definitely borrow short-term money below 5%, 1, 2, 3 year money. And that can be used to ease these people out of the market. So effectively, the federal government is going to have to go back into the private market, the Eurobond market, much sooner than they would like to admit, because they need significantly more money than all the DFIs combined can provide.
Now, Egie, as the CBN's unification of forex windows continues to gain momentum, I'd like to know what your outlook for the naira is.
Well, I think in terms of the outlook for naira, I think clearly the CBN has been moving in the right direction. It will help if we just got rid of most of these so-called windows. The exchange rate will clearly go slightly higher than where the INE window is, because if the INE window was such a great rate, you'll have inflows coming in through that market and there's virtually nothing coming in. Everything is trying to go out. So obviously it has to do some adjustment. But in practical reality, where the parallel market is, about 460 is clearly somewhat an inflated number driven by a number of variables, including supply to BDCs and a few other things. So in all likelihood, when normalcy returns, including BDC supply by the CBN, we would expect there to be a much stronger convergence between all the official windows and the parallel market. And that will probably be somewhere in the 400 region. But clearly, the central bank is moving in the right direction.
And what do you reckon is the actual true value of the naira? This has been a point of speculation within the market space in the last few days.
Well, I think we need to bear in mind that the value of the naira changes on a daily basis. Even when you if you look at the currencies that somewhat float, that are very petrol linked, even the Canadian dollar. I mean, these currencies have fallen very substantially in line with the movements in the oil price. So on any given day, the value of naira is slightly different from the next day, depending on other variables. But it's probably somewhere plus or minus 5%, 400 naira to a dollar when all the dust settles. Now, the question is whether the system will allow that dust to settle and whether the government will do what it takes to boost the reserves that give confidence to those holding the currency.
Egie, many thanks to you for your time. Egie Akpata is the Director of Union Capital Markets.